Alright, stackers, take a breath and look at what just happened. For years, people have treated silver stacking like a quirky hobby, old money. Doomsday coins. You'll never see it move. Meanwhile, we kept saying the same simple thing. The silver market has been running on a paper dam. And that dam wasn't built to hold forever. Well, today it didn't leak. It didn't crack. It came apart. Check the close from the electronic session. Silver is trading at $79.25, up $7.34 in a single day. A 10.21% move. And let me say this in plain English. Commodities don't do that on a normal day. A 10% move isn't a nice rally. It's a forced unwind. It's the moment someone on the wrong side gets dragged out of the building. Somewhere out there, a major short just hit the wall, and when the margin call came, they didn't negotiate. They didn't wait for a pullback. They just smashed the buy button until the account hit zero. And because this happened during the thinnest liquidity stretch of the year, Ghost Week, there weren't enough real sellers on the other side. So the price didn't climb. It jumped. It went vertical. We're now standing on the doorstep of $80. And what happens next matters even more. If silver holds this into the weekly close, the Sunday open could trigger exchange limits that freeze the entire game. In this emergency update, we're going to break down what a melt-up really is, why gold at $4.534 is screaming something bigger about the dollar, and, most importantly, how to keep your head on Monday morning. Because the rules just change, and the panic hasn't even warmed up yet. Stackers, here's why that first line matters even more than the price print. When we say we've crossed an event horizon, we're not trying to sound poetic. We're naming the moment where the old explanations stop working. Before today, you could explain almost anything away. A spike? Just a headline. A sell-off? Just paper games. A breakout that fades by lunch? Told you so. That comfort story keeps people passive because it assumes the market is basically normal and will always snap back to the same script. An event horizon hook does the opposite. It tells you, right away, that you're watching a regime shift, one where normal behavior stops being a reliable reference point. And the tape starts writing its own rules in real time. That's why the dam metaphor hits stackers so cleanly. The plumbing can get complicated fast, but the feeling is simple. Pressure building behind something artificial. A dam doesn't have to look evil to be dangerous. It only has to hold back force long enough that people stop checking the waterline. The hook compresses years of, "why won't this thing move?" into one image you can feel in your bones. Then it refuses to describe today as a small crack. It doesn't say the wall leaked. It doesn't say it bent. It says it disintegrated. That single word is doing a lot of work. It tells you this wasn't a routine fluctuation, it was structural failure. Now, look at the scoreboard. Not the opinions, not the vibes. The close. Silver at $79.25. Up $7.34 in a single trading day. A 10.21% move. Those numbers do two jobs at once. First, they prove something abnormal happened. Commodities don't print a clean double-digit day under normal market conditions unless something underneath them is snapping. Second, they give you an anchor you can't argue with. You don't need a chart pack to understand 10% in one day. It's a number you can repeat, share, and remember. It turns a story into evidence. And notice what the voice does right here. It shifts from narrative to command. Look, check the data. Let me be crystal clear. Commands flip you from passive listening into witness mode. Like someone turning your head toward the window and saying, "See that? That's real." A timestamp turns it into history. A closing print turns it into proof. The math turns it into something you can't hand-wave away, even if you don't like the tone. Big language gives the moment meaning, hard numbers give it credibility. That combination is exactly how you pull a viewer deeper without feeling like you're forcing them, because you're not asking them to believe you. You're asking them to verify what's on the screen. Finally, the hook pays off emotionally for stackers by reframing you. If you've ever felt awkward telling someone you stack, like you had to defend why you care about a metal most people ignore, this moment hands you a receipt for your attention. It implies you weren't crazy, you were early. You weren't paranoid, you were observant. The screen is finally forced to admit, in daylight, that the pressure was real. And once you accept that we've crossed the line, the next question isn't, will it pull back? The next question is, What does a 10% day actually mean? And who just got forced out to make it happen? Once you accept that we've crossed the line, that this isn't just another candle, but a new regime, the next battle is psychological. Because the market doesn't just move your portfolio, it moves your interpretation, and if you let your brain label what happened the wrong way, you'll react the wrong way. That's why the script immediately slams the brakes on the casual take. You see 10% up and your first instinct is to celebrate, nice rally. Good news, green day, victory lap. But then comes the gatekeeper sentence, the one designed to seize your emotions before they run off the cliff. Commodities do not move 10% in a day under normal market conditions. Translation: if you're treating this like a normal rally, you're already behind the event. Now watch the relabeling sequence. Because it's not just dramatic, it's controlled. First, not a rally. That cuts the dopamine. It stops you from getting sloppy. Second, a liquidation event. That changes the cause. A rally implies willing buyers. Optimism, a smooth trend. Liquidation implies force, constraint, margin, and time running out. It tells you someone didn't choose this, they were dragged. Third, a crime scene. That's the hardest label, and it's there for a reason. A crime scene means damage happened. Someone got hurt, and the evidence is still fresh. It implies consequences will follow. It also signals that you should be looking for the body, not the headline. And then the story drops the human hook, the death of a major financial entity. Notice how it doesn't name names. That vagueness is intentional, because it turns into a mirror. Your mind starts filling in the blanks. A bank, a fund, a desk, a big player you've heard rumors about. You don't need the identity for the emotion to land. You just need to believe someone big snapped. And if someone big snapped, the move wasn't buyers getting excited. It was someone trapped being forced to pay any price to escape. Here's the cinema part. The part that makes the plumbing feel like a scene you can see. Imagine a short position so large it becomes a ticking bomb. The margin call hits. There's no debate. No, wait for resistance. No, let's see a pullback. The only instruction left is, close everything. Buy back every contract at market. Not because it's smart, because it's mandatory. And in that moment, the buyer doesn't care about cost, chart patterns, or overbought. They care about one thing, survival. So they smash the buy button until the account balance hits zero. Now add the final amplifier, Ghost Week. Thin liquidity, few real sellers. That's how a price doesn't climb, it teleports. That's how the candle goes vertical. And that's why stackers should hear the subtext. When price moves like a forced exit in a thin market, it's not a celebration, it's a signal. The system didn't rally, it flinched. If the last layer was the emotion, this isn't a rally. It's a crime scene, then the next layer is the forensics. Because once you stop celebrating the candle and start respecting it, you naturally ask the only question that matters. How does a market move like that without asking permission? And this is where the story gets calm, almost soothing, because the how is not mystical. It's mechanical. It's paperwork turning into physics. In a normal market, price is a conversation. Buyers bid, sellers ask, and they meet somewhere in the middle. There's ego, patience, and choice. People wait for levels. They argue about resistance. They talk about fair value. Even when the tape is fast, it's still negotiation. But a liquidation market is different. A liquidation market is not a conversation. It's an evacuation alarm. And the moment that alarm goes off, negotiation stops, because the system has one job above all, settlement. Here's the quiet villain in the room, the clearinghouse. Not a person, not a conspiracy, a function. It stands in the middle to guarantee that trades settle. That guarantee is what lets everyone pretend the market is liquid and orderly. But it comes with a rule the crowd forgets. If a participant can't meet margin, the clearinghouse doesn't discuss it. It acts. It steps in, takes control of the failing account, and forces the exit. Think of it like a pilot taking over the plane when a system fails. No opinions, no vibes, just procedures. And that's the key. The forced buying engine is intentionally mindless. It has one instruction, close the position now. It doesn't care if silver is overbought. It doesn't care if the chart is screaming exhaustion. It doesn't care about your favorite level, your trend line, your technical setup, or your macro thesis. It cares about removing exposure before the hole gets bigger. So it buys whatever is offered, at whatever price is available, in whatever size is required. That's why you get the phrase that sounds dramatic but is actually literal. It consumes the order book. It eats through the sell offers stacked at each price level until there's nothing left nearby. When that happens, the next available sellers might be dollars higher. Not because the market believes silver is worth that much, but because the nearest liquidity has already been eaten. This is why the vertical candle matters. A vertical candle isn't always momentum. Sometimes it's impact. It's the footprint left behind when a large participant is forced to move through a thin hallway at full speed. That's also why volume and speed are part of the evidence. A slow climb can be enthusiasm. A sudden jump with violent range can be obligation. It looks less like a crowd buying and more like a whale dying, thrashing, forcing waves, changing the shoreline even if nobody wanted the water to move. So the how collapses into one brutal sequence you can remember: margin failure, takeover, forced buying, order book exhaustion. No mystery, no magic, just rules doing what they were built to do, at the worst possible moment. And for stackers, that's the calmer takeaway. When you understand the mechanism, you don't need to guess whether the move was real. You can see the machinery. You can hear the alarm. And you can tell when the market is no longer negotiating, it's liquidating. Once you understand the mechanism, margin fails. The clearinghouse takes the wheel. The order book gets consumed. The story can't stay small. Because a forced liquidation isn't just one trader having a bad day. It's the first crack you can actually see from the outside. And here's the hook that changes everything. In markets, one forced exit is rarely the end of the story. It's the start of the audit. When a big position blows up, it doesn't disappear. It gets transferred through the system like voltage, searching for the next weakest link. That's why layer 4 widens the lens from a single, whale dying candle to a domino line running through the financial food chain. The first domino is always the smallest and loudest: retail shorts and over-leveraged speculators. People who thought they could fade the move with cheap margin and clever timing. When price goes vertical, that crowd gets swept first. But the market doesn't stop there. Because the next domino isn't a person with a laptop. It's a balance sheet, family offices, small funds, desks that size up because they've done it before and think they can do it again. They don't view silver as a threat. They view it as a trade. And trades, by definition, assume you can exit. Then comes the tier that matters: institutional funds and the structures built on borrowed confidence, positions hedged with assumptions, financed with short-term funding, and protected by models that only work in normal conditions. Remember the event horizon. Normal conditions are gone. When liquidity thins and the tape gaps, models don't negotiate either. They recalibrate. And recalibration is just liquidation wearing a clean suit. Now the implication the script quietly points toward, without shouting it, is the tier that stackers have been watching for years: the bullion bank layer. The institutions that sit closest to the plumbing, the ones that warehouse risk, provide liquidity, and make the paper market look deep until the moment it isn't. This matters because squeezes don't end when the first domino falls. They end when the dominoes reach the largest, most interconnected pieces, when the system has to choose between absorbing losses or changing the rules. And that's where the meaning of a 10% day gets upgraded. It stops being, silver did a crazy thing. It becomes a symbol of something broader, a repricing of trust. A market can survive volatility. What it struggles to survive is a collapse in confidence in counterparties. In settlement, in the unit everything is priced in. When the script says, in plain spirit, get me out at any price, it's describing a behavior you see in every monetary shift. Capital doesn't calmly rotate. It flees. And when capital flees the unit of account, everything denominated in that unit has to adjust, fast, unevenly, and sometimes violently. So the domino narrative isn't just drama. It's a warning wrapped in a roadmap. Today's candle may be the first visible failure, not the final one. And if this is contagion, the next episodes won't be about charts, they'll be about solvency, funding, and who the system decides to save when the exits get crowded. If the domino layer makes you feel the scale, this isn't one trader. It's a system trembling. Then the next question is the one every stacker asks after a vertical candle. Okay, but am I late? That's where gold enters the story. Not as a distraction, but as the credibility engine, the calm older brother that tells you whether silver's chaos is random noise or part of a bigger regime shift. Here's the hook. Silver can sprint, but gold sets the compass. Gold tends to move first. Not because it's more exciting, but because it's the primary monetary thermometer. When gold breaks out to numbers that feel psychologically impossible, say $4.534, with $4.500 as a level that makes people blink, the market is broadcasting a simple message. Confidence in currency is being repriced. And once that message is on the tape, silver's violent move stops looking like a fluke. It starts looking like a delayed reaction, like the sidekick finally catching up after the lead actor changes the scene. Now comes the part that steadies the nerves: ratio math. When emotions are running hot, the fastest way to calm a stacker's mind is to hand them a yardstick. The gold to silver ratio does that. If you use a historic reference point, say 15-1 as a long-run monetary anchor, you can do the mental math in 5 seconds. Gold at roughly $4.500 implies silver at roughly $300. That doesn't mean silver teleports to $300 tomorrow. It means something more important. Even at $79, silver can still be framed as cheap relative to the monetary signal gold is sending. That framing matters because it flips the feeling from, "I missed it," to, "This is still early in the repricing." Then the script adds a second, modern logic layer: the catch-up trade. Algorithms don't fall in love with narratives, they scan relationships. When gold pushes into new ground, machines look for laggards, assets that historically track the regime but haven't fully repriced yet. Silver often lives in that gap, more volatile, more ignored, and easier to misprice until it suddenly isn't. If gold is already reflecting inflation reality and currency stress, and silver is still miles below its inflation-adjusted extremes, silver becomes the obvious, last door, trade. Not because it's safe, but because it's late, and in markets, late assets can move the fastest. And here's the gentle, grounding point for stackers. Breakouts are rarely clean. Suppression looks orderly because it's a lid. Freedom looks messy because it's price discovery. A chart that teleports and goes vertical doesn't automatically mean the move is over. It can mean the market is finally admitting what it spent years denying. The bullish takeaway lands best when it sounds mathematical, not emotional. Gold validates the regime shift. The ratio provides context, and the volatility becomes the signature of a market breaking loose, not a market topping out. If gold is the compass and the ratio is the yardstick, the next step is where stacking stops being a chart hobby and becomes a real-world test. Can you actually get the metal? Because in a true repricing, the market doesn't break first on your screen. It breaks first in availability. And here's the hook that hits every stacker in the gut. Spot only matters when you can buy at spot. The moment you can't, the screen becomes a suggestion, not a price. That's why this layer deliberately moves the story from candles to checkout pages. Weekends are a pressure cooker for precious metals. Markets are partially closed. Liquidity is thin, and information spreads faster than price can update. The screen freezes, but the narrative doesn't. Headlines multiply, rumors multiply, DMs multiply, and the question that quietly infects everyone holding paper exposure is the same one that always shows up during stress. Will the exchange open normally? Will my broker honor the trade? Will settlement be smooth, or will it become terms and conditions and a long email chain? That's counterparty fear, and it's not irrational. It's what happens when trust becomes the variable. Then comes the signal that stackers respect more than any chart pattern: dealers pulling inventory. Sold out, site maintenance, call for pricing. At first glance, it looks like chaos or marketing. But in a fast market, it's often just self-preservation. Dealers run on inventory risk. If silver is moving in dollar leaps while the weekend is half closed, quoting a fixed retail price is like trying to catch a falling knife in reverse. They don't want to sell the last boxes at yesterday's premium and wake up unable to restock. So they step back, pause the cart, and wait for the new equilibrium. That pause is the tell. It means the physical market is struggling to make a clean price under stress. And that's where the stacking thesis sharpens. When availability breaks, spot becomes irrelevant. If the screen says $79 but the only real offer you can actually execute is closer to $100, then the price isn't $79 in the only sense that matters to a stacker: acquisition. That gap between official quote and real-world availability is the oldest symptom of monetary stress. It's what happens when the unit of account is still being printed on screens. But goods are being rationed in reality. The market is telling you, without saying it out loud, that the number you're staring at is no longer the whole truth. This contrast, frozen screens versus desperate street pricing, is exactly why physical ownership feels different in moments like this. Paper promises are fine when the system is calm. In a pressure cooker, the question becomes delivery. Do you have the thing, or do you have a claim on the thing? Stackers already know the answer they prefer. And when dealers go quiet at the same time charts go vertical, it whispers a message that no influencer needs to hype. The vault doesn't have infinite metal. And the moment of truth always shows up first at the shelf. When physical availability starts to wobble, the next arena is the one the screen can't hide: the rules of the exchange itself. Because once the weekend pressure cooker is set, the Sunday reopen becomes more than a session, it becomes a stress test. And here's the hook that makes every stacker sit up straighter. The market doesn't always keep trading just because you want answers. Sometimes the system hits its own panic switch. That panic switch is the circuit breaker: daily limits, halt rules, limit up conditions. On paper, it sounds boring and administrative. In reality, it's cinematic. If silver gaps higher on the open and pushes beyond the allowed daily range, trading can stop. The screen freezes. No bids, no offers, no clean price. Just a halted market and a crowd staring at a number that can't update. That visual is powerful because it flips the normal relationship. You're not watching price. You're watching the system decide whether it can even handle price. And the suspense comes from timing. Silver closes high, liquidity is thin, a gap up is possible. If the first wave of orders hits and there aren't enough sellers willing to step in, the limit can trigger fast, sometimes minutes. That's why the reopen feels like a cliff edge. You either get a normal session, or you get a locked door. Now the script does something smart. It puts you inside the short seller's body. Not to pity them, just to explain the pressure. Imagine being down millions, needing to cover, and the only exit is a door that just got welded shut. Your risk manager is calling. Your broker is calling. You're staring at a market that says, halted. That's why the burning building metaphor works. It turns an abstract rule into a physical trap. In a limit up halt, the short isn't losing because they made a bad bet, they're losing because time, liquidity, and rules are now the enemy. Then comes the emotional flip that matters for stackers. If you see a limit up halt, don't instantly interpret it as the exchange is broken in a bearish way. A limit up halt can be a sign that demand is overwhelming the exchange's capacity to provide orderly trading. In other words, it can be validation, not failure. It's the system admitting, we can't discover price fast enough without breaking something. That's not comfort, it's confirmation of stress. But validation has teeth. When limits expand or trading resumes, price discovery can get violent. A market that was frozen doesn't restart smoothly. It often reopens with air pockets, thin books, sudden jumps, and ranges that would feel impossible in calm conditions. That's where the practical message lands with a quiet, steady tone. This is not the environment for cute leverage games. Margin turns you into the short seller in the burning building, needing an exit on someone else's timetable. Stacking is the opposite posture. It's ownership over borrowing, patience over panic, cash over margin. And if Sunday opens into a halt, the real takeaway is simple: the system is under strain. And in strained systems, having the thing beats having a claim on the thing. If Sunday's reopen is the stress test, then what comes after is the part most people get wrong. They treat the spike like a finished story. One candle, one shock, one viral screenshot, and then their brain tries to close the book. But the whole point of a regime shift is that the candle isn't the ending, it's the opening chapter. Here's the hook that keeps stackers locked in without panic. A 10% day doesn't answer questions, it creates them. It doesn't mean it's over. It means the next wave is now aware. This is why the script drags your attention forward into January. Not because January is magical, but because it's structural. New allocations, new mandates, fresh risk budgets, performance pressure reset at the calendar. Big money loves the idea of being early, but it hates the feeling of being left behind. So when silver prints a clean, undeniable 10% day, it becomes an alpha signal in the institutional world. The kind of move that gets flagged by models and talked about in Monday meetings. And here's the irony. The more violent the breakout looks, the more attractive it becomes to allocators who are paid to chase momentum. Not to hunt bargains. They don't buy because it's cheap. They buy because it's moving and they can't miss the trend. That sets up the forward lock. If a wall of money arrives in January and the market is already structurally strained, thin liquidity, shaky confidence, stressed availability, the next leg doesn't need a perfect headline. It just needs flow. That's how the script can point toward a path to $100 without sounding like fantasy. Not as a promise, but as a consequence. When size chases a narrow door, the door doesn't politely widen. But credibility requires honesty about turbulence. Nothing goes up in a straight line, especially not silver. A vertical day often triggers profit-taking, shakeouts, and vicious pullbacks that are designed, intentionally or not, to scare weak hands into selling. And in a market that's gone vertical, a big move down can be small in context. A flush from $79 back toward $75 can feel like disaster to a newcomer, while a stacker reads it as the market catching its breath. In a regime shift, volatility isn't a bug, it's the signature. The trick is not to confuse noise with reversal. Then comes the darker, quieter layer. A 10% move with no clean headline can imply the headline is coming. Sometimes price moves first because information is uneven, positioning is early, or stress is happening inside the plumbing before the press can name it. That's why the philosophy lands so hard. Price leads news, and news follows price. If you wait for the perfect explanation, you often arrive after the move, and after the best decisions. So the guidance becomes simple and steady. Don't short parabolic strength out of principle. Because markets can stay irrational longer than your margin can survive. Respect asymmetry. If the system is stressed, upside can gap in ways downside rarely does. And for stackers, the forward lock isn't fear, it's preparation. The next act is about flows, not opinions. And January is where flows get loud. If the forward lock is the warning, January flows, turbulence, and price leading the headlines, then the final layer is the antidote. A battle plan that turns adrenaline into discipline. Because this is the moment where most people ruin a good position without ever making a bad call. They get the thesis right and the behavior wrong. They watch history happening and then overreact to the noise, selling the bottom of a breakout or chasing the top of a spike. So the first instruction is the simplest, and the hardest: stay calm. Not because nothing is happening, but because too much is happening. Calm keeps you from making emotional trades in a market that's designed to punish emotional timing. Second, treat your metal like what it is right now, a high-value asset. In calm times, people talk loudly about their stacks like it's a hobby. In stressed times, loose talk becomes a liability. Keep your mouth shut. Don't flex. Don't broadcast purchase sizes or storage methods. Make storage decisions like an adult, not a cheerleader. Diversify where you keep it. Don't rely on one single point of failure. And don't assume it'll be fine is a security plan. When the narrative heats up, attention follows. The quiet stacker is the safe stacker. Third, audit your counterparties, because in a system story, counterparty risk is the real risk. If your exposure is unallocated, pooled, rehypothecated, or purely paper, you are not holding metal, you're holding a promise. Promises can be fine, until they aren't. Read the terms. Understand what triggers settlement delays, substitutions, or cash payouts. Know who holds title, who holds inventory, and what happens if the chain breaks. Even if you use popular ETFs or brokerage products, the goal isn't to panic sell, it's to know what you truly own and what depends on someone else staying solvent. Clarity beats assumptions, and in a regime shift, assumptions are the first thing that gets repriced. Fourth, be ready for weekends and reopenings. Expect gaps, expect halts, expect the screen to freeze and your group chats to explode. Don't confuse a frozen market with a collapsing price. A limit up halt is not the market going to